Hello guys, welcome back to my channel. I'm Andrea. I had now some longer break with my YouTube videos because of extended workload, and then I was also sick for the extended time, as you can still hear on my voice. But anyway, I am here on the page of the ExxonMobil. They released earnings and the stock went down because they missed analyst expectations. And today I want to share with you my notes or my key takeaways from this earnings call. I will try to keep this video as short as possible, but if you are interested in some extended version, please let me know in the comments. Please also note that this is not a financial advice. You should always do your own research and consult with a professional before investing in anything. So despite 34 billion in earnings for the last year, which is the third highest in a decade, Exxon earnings was lower than in 2023 and lower than analysts expected, as I told you already. This is caused by the oil and gas prices declined in 2022 and 2023. The oil prices, due to the shock in the conflict of Ukraine, rise, and now after the supply chains stabilized and oil from the Russia find its way to the market, the prices start decreasing again, which is good for consumer. It's also not a problem for the Exxon, but market didn't like it. Also, the refining margins weakened as supply chains disruptions eased, which resulted also to weaker chemical margins. The second big point why the earnings in Exxon decreased was major growth in investments. So they are increasing capital spending in Permian Basin, Guyana, in LNG terminals after the restriction for LNG terminals was lifted with the new Trump administration. And they are also investing in low carbon solutions like carbon capture and hydrogen and similar projects. Increased production cost due to higher inflations and supply chain cost. And they also, as I thought, expanding in the new businesses, the hydrogen and carbon capture business. They had also some changes in working capital, and also one-time tax adjustment and impairments. Yeah, and the biggest point is that one-off gains as extraordinary high oil prices from the last 2 years did not repeat this year. As I told in my previous videos, I wouldn't be surprised if this year or beginning of next year we see oil prices somewhere around $50 per barrel. This will be caused because the new Trump administration want flat market with oil to drive energy costs down and ramp up the economy like this. Excuse me. Sorry for that, my voice is still not as good as it used to be. But I guess you don't invest in Exxon and expect that it will 10x from this. I guess most investors, including me, are investing to this company mostly because of the dividends They are over 40 years of increasing dividends. They increased dividends for 4% also this year. And the dividend is very safe, stable, and this will not change also in the future. So they have free cash flow of 34.4 billion in the last year, 2024. Or if you want free cash flow excluding working capital increase of 1.8 billion was 36 billion. So it doesn't matter if you take 36 billion or 34 billion, because the dividend they are paying are only 16.7 billion, and the 19.3 billion go to share repurchase. They increased their share amount in the Q2 of last year because of the Pioneer acquisition. And this was also in the earnings call, one question from the analyst. So Exxon wanna have a now extended share repurchase program for the next 3 years to drive share amount on the states it was before the Pioneer acquisition. Anyway, analysts are expecting a share decline of 2.4%, 2.5% for the next 3 years. So doesn't matter if they have a dip in the earnings, even if the oil prices will dip to $50 per barrel this year. If this will happen, the oil prices will not stay on this level for extended period of time. This is not possible due to the demand as we have, as our economies have. So, but even if this happen, they can still maintain this dividend and also increase it. So, this is a nice dividend play, and I don't know what happened with the share price in the short term, but in the long term it will, I guess, grow more than inflation, so it will also protect your principal. Yeah, so to sum this up, Exxon earning decline due to lower oil prices, weaker refining margins, and higher investments. The company want to position itself with this for stronger earnings in future. So they are doing this through the expanding the oil and gas production, building high margin chemical and refining business, and develop a low carbon solution for the long-term profitability. Exxon expects earnings to rebound in the coming years as the project come online and start generating cash flow. Long-term investors should see this as a strategic move rather than a setback, but the short-term oriented Wall Street analysts see this usually as a negative sign because market hate uncertainty and investments are always connected with uncertainty. So if you like this video, please give me a thumbs up and leave a comment, and I hope to see you in another video. Bye.